Oil has been one of the big trades in 2016. As a result, some stocks in the sector have shown stunning year-on-year returns. This year, we've been following Malcolm Graham Wood's bucket list of stocks from the oil and gas sector. And Malcolm from HydroCarbon Capital joins us now with a year in review and looking ahead to 2017. It has been a stunning year, hasn't it, this year? But we've seen oil go from, what, sub 30, now where we are just above $50 a barrel.
Yeah, it looks okay at the moment, and I remember speaking in here saying that all the way through since about May, I've kept $60 as my year-end target, and it looked several times as I should trim that down, but I think I'm going to fluke it this time, and the stocks are very similar because the numbers we've got so far are year-to-date numbers. The bucket list is created and rearranged in the end of January, so at the moment it's looking pretty good, but you know we have been bailed out to a certain extent by the oil price. But
well, there are some individual stories there, though. Let's beat about the bush. Let's bring up the list first of all, if we can, and take a look at where we are, because some, as I said, some stunning returns. You've got near 50% gains there for. 500% gains there for some of those stocks, including Hurricane. What are your picks out of this? I mean, we went into 2016, I think Pantheon was the best performer in 2015. That's down 15% now. But just pick out a couple of stocks.
Okay, well, I mean, we can go through in little sort of groups, really. I mean, the real raging successes have clearly been Hurricane and Sound, plus Ithaca. So Hurricane and Sound have specific reasons for that. Hurricane have been funded and been successful in their Lancaster discovery in the West of Shetlands, and they've had nothing but success. They've just announced yesterday, the further success in the third well. They're about to drill another one. They've already ordered an FPSO. You know, they'll have production by 2019. So, you know, an absolutely resounding sort of vote of confidence in Dr. Trice, who is the, you know, never disbelieved that his fractured basements would work. Sound Energy, obviously, the other one where, you know, the shares were, you know, 15 or 16p all the way through to the summer, and then all of a sudden this huge gas discovery onshore Morocco came through and could be worth significantly more. So that's the big one. The biggest performer as being a run-of-the-mill stock is Ithaca, which had crazy price of sort of 20-odd-p back in January. And this is just a really well-run company. The big thing for Ithaca is that 2 years ago, they hedged all their oil for 2, 3 and 4 years. So in the middle of this year, they were still getting $60 and $70 a barrel. So paying down debt, their big sort of thing that held them back had been the rig for the North Sea. Now that's in the North Sea, they'll start producing from that in January, paying down even more debt. So those are the sort of big surprises. And I'll just sort of pick out one or two others. Would you like me to pick out one or two?
Please do, yeah.
I mean, probably the danger stock to pick in January was Premier. It had been suspended, people were very worried, it had a lot of debt, but operationally it's had a really cracking year. It's made a very good acquisition. It's had a cracking year in terms of the actual operational performance. And so although it is still waiting to sign off debt, which is the only major concern left at the moment, and they've had a little bit of, you know, one or two little problems, but, you know, so Premier was probably the bravest call. Probably the ones that I'm most proud of, in a way, Tullow and Cairn. I mean, Tullow in particular. The reason I say that is not just because it's up 220% on the year, but also it's a 3.1 billion market cap company. So not only, you know, was it, you know, it had been pretty unpopular for a couple of years, but also, you know, in terms of a stock like that, in pounds made, we've made more being up 200% for a 3 billion market cap company. And Cairn is a £1 billion market cap company, and it's up 60%. And viewers should watch out because Far Limited, which sits there down 10%, and Cairn is up 60%. And the reason they're tagged together is that they're both in the same huge discovery offshore Senegal. So why isn't Far up 60%? I'm of the view that in value terms it should be worth significantly more to Far than to Cairn. But of course there's been a sort of technical there. Conoco were walking away from offshore acreage, so they sold their portion to Woodside in Australia. And Far have actually tried to preempt that. So it's in court at the moment where, you know, they're saying that the Senegal government haven't approved it. When, you know, that is resolved one way or the other, things will, you know, will settle up, and Far is far too cheap at the moment.
Let's take a look at some of those as well on the way down. Rockhopper, I think, is one of the poorest performing on this list here. South Atlantic We know it's deep water there. There's all sorts of problems politically as well in that area around the Falkland Islands and so forth. Down 23.
Yeah, I mean, that's specifically. Rock copper has always been in the bucket list in order to be a slow burner. At some stage, it's Sea Lion discovery, which is in there for virtually nothing, and it's a 1 billion barrel prospect. I think that it'll still be in as a slow burner. But the reason it's come down is because Premier hold the rest of it. And as long as Premier are struggling with their debt, they may not get the approval to go ahead. So what they're waiting for is Premier to effectively farm out quite a lot of their holding in the Sea Lion, and then things will go better. In the meantime, people aren't quite sure what Rockcopper's going to do on the back of that.
Pantheon Resources, we've mentioned this at the top because one of the best performers are saying it's a little bit of a breather this year, bearing in mind it's pretty much holding on to the 700% gain we saw the previous year.
I mean, I'm not at all worried about Pantheon at the moment. I mean, at this very moment in time, they're completing the testing on their third well, and the fourth well is drilling, and that'll get to total depth in a couple of weeks' time. So actually, between now and the time when I close up the bucket list at the end of January, that thing might have changed dramatically, because there are two results that have come through. I've got a feeling that the third well is going to be producing modestly, but the fourth well may come in. But bottom line is, you either got to believe the dream. I mean, there's a number of these stocks, like Hurricane, like Sound. You have to have them in a bucket list. The reason for a bucket list is in order to have some with some high risk and some with less risk. And if the ones with high risk happen to come in, with a really big well, then they're going to go up 3 or 4 times, maybe more. That's what happened to Pantheon last year. But they've still got. I still believe that Pantheon have cracked the code, and so actually down 15%, it's probably a stronger buy than most things. Trying to pick what's going to stay in the bucket list next year is going to be very difficult in January.
When you put this list together, you always warned there would be lots of, I think sex and violence is the way you put it, didn't you? Because you're going to get these big wild gyrations in some of these stocks. How do you feel about 2017?
Well, I'm reasonably positive, actually. I mean, the fact that the oil price looks like it's going to be about 55, 60 at the end of this year means that providing the OPEC agreement can hold, and it is a big providing,
and non-OPEC, of course, isn't it?
Well, yeah, I mean, I'm calling it the OPEC with non-OPEC, and providing that holds, and I think it probably will, because they probably have to, and in particular Saudi. We've talked about this before with the Aramco IPO coming up next year. They don't want that to be a $30 backdrop. They want it to be a $60 backdrop. So Saudis will probably end up being a bit of a swing producer. I think that the supply and demand numbers look poor for the first half, but this 1.5 or so million barrels will keep that intact. As we look towards the second half of 2017, I think, and obviously onwards, I've been going on about this with you for a year now, about these capex costs. The capex have been cut so dramatically that we're now at least $1.5 trillion worth of capex. Now, BP announced the other day, and in fact BP have been quite lively in the last few days, but they announced that, for example, they were going back to Mad Dog 2, which is their big Gulf of Mexico discovery, and they've decided to go ahead with that. And there are two interesting things about that. First of all, they're going ahead with it because when they first looked at it 2 years ago, it was going to cost $22 billion. It's now only 10, so 50% of what it was. Second thing is, if they press the button now for Mad Dog 2, first oil won't be till 2021 or 2022. So all those things that have been withdrawn from the market, all the capex cuts, even if you ask them to go back to them straight away, we're not going to get any oil for 5 years.
So this is a supply squeeze, isn't it? What sort of addition is you going to see on the price of oil because of that, do you think?
Well, there'll be a bit. Don't forget, some of that will mitigate it, because 2017 is going to be the year for American Shale. Sure, yeah. Because they can come on straight away and take advantage of the higher prices. Yeah. So those companies will be doing pretty well. And there's middle-sized companies all the way up to Exxon who are in that. But, I mean, I think that they won't squeeze big time straight away. I've got $70 in for the middle of next year as a sort of penciled in, and just see how it goes. By the end of next year, I'm sure we could be talking about 80. And the thing is, it turns around very quickly. When you do, in, say, 2019, where you're looking out to 2019, there's going to be a shortage. The American shale can only produce another, 1 million barrels tops. You're probably going to need 2 million at that stage. And what happens if China reverses the demand, or India? We're expecting demand to be down from those huge engine economies.
Okay, well, look, we'll have you back in January. We'll take a look at the new bucket list when it comes through and see which ones get kicked off, if indeed any do. And, of course, we'll take a regroup as well on the price of oil.
Yeah.
Okay, Malcolm, thanks so much indeed for joining us. Malcolm Graham-Wood there from HydroCarbon Capital with a look through a near-end review of his bucket list.